Are you excited to become a professional Forex trader but struggling with where to get started? Rest assured we understand this is perfectly normal and we've got you covered. In this video, I'm going to be breaking down why Forex is much different than other asset classes and how to position yourself as a professional FX trader. So Sean Kozak here, tuning in again with North Street Trading Academy. And for the world's best trading education and strategies, be sure to hit that subscribe button, turn that notification bell on. That's going to make sure that you get notified every time we put out content so you get results. Last but not least, give me a thumbs up. That we know you like the content and you're engaging with us. So what we're going to do in this video is I want to talk about the importance of the content that we're going to show you here today. In our trading rooms at NeuroStreet, we have a lot of professional Forex traders. And the reason they're so successful is because these traders know their markets. And we want to make sure that you truly understand the foundation in the Forex market before you start trading so you can avoid the pitfalls that many traders fall into, okay? So let's kind of talk a little bit about these 5 major areas of discussion. Forex is very different than other asset classes. Maybe you're a stock trader, cryptocurrencies, options, futures, whatever your experience level is, we want to make sure that you know the difference between Forex and these other assets. Then we're going to go into currency distribution, the flow of money through every country and the economic movement of money and the volume that the foreign exchange market brings to the table. Then we're going to go into Forex news. Forex news is super critical because it's very different than, say, companies releasing earnings. Forex is driven by economic reports and country-specific reports, and you need to know when these reports are coming out because it's going to heavily dictate the movement of the markets that you trade. Then we're going to go into hours, sessions, and volatility. Forex is a global market. You can trade it around the clock. You also can trade different sessions, the Aussie and the Asian session, the London session, the US session, right? So you want to know the sessions, the hours, and how volatility and the average pip movement plays a factor in trading the right markets during the right times. And then we're going to wrap this all up with knowing the difference between the exchanges. Foreign exchange markets are very different than the other exchanges like Wall Street and Chicago. And we want to make sure that you know the difference, especially with regards to order routing, so that you know how the Forex market moves. So I know this sounds like a lot, but it is important information and it's critical that you learn this stuff if you want to become a successful Forex trader. So let's not waste time. I'm going to make it super simple for you. Let's jump onto the screens and get you started. Hey there, traders. What we're going to do in this video is we're going to kick the Forex 101 program off by talking about the Forex Explained Part 1. And essentially, this is going to be a foundation lesson to the Forex, foreign exchange markets, aka Forex. And if you're new to Forex, sit back and enjoy the ride because there is a lot to learn. And if you've got some experience, this is definitely going to be a refresher as well as an expansion because we've got a lot of different educational lessons here. We're going to be talking about foundation classes here in this video. We're going to be going over pairs and speculations and watch lists in the next video. Then we're going to talk about pips and pipettes and then the leverages and margins. We've just got a lot of stuff to talk about over the next couple videos. So what we're going to do today is we're going to build a strong foundation so that you have a really good understanding about Forex trading so that as you move forward with our school into our online courses and into the classrooms and into the strategies courses, you'll have a really good understanding of the asset that we're trading. So as with all the other videos, like the stock courses and the futures courses and the Forex courses, if you have any questions or if you need assistance with our team, just let us know. If anything is unsure or if you don't really understand something, let us know so that we can help you because that's the whole purpose is we want to make sure that you have a good understanding of this moving forward. So let's talk about Forex. Right? What is Forex? Well, Forex is also a name for foreign exchange markets. And my only suggestion is we want to relax a little bit. It's not as complicated as a lot of traders think. In fact, once we break this down, you're going to find that it's actually quite straightforward. Now, the FX market, what I like is that it provides unparalleled access to the most basic and in-demand currency products in the world. So the FX market, when I say FX, I'm just mean foreign exchange, is the largest and most liquid market in the world to trade with. They have over 5 trillion in US dollar denomination in volume daily. So it is the big brother in the room. It is definitely the big player out of all of the markets. It's 200 times larger than the stock market. and approximately 5% of the liquidity is retail traders. The rest is made up of big banks and institutions. Now, the reason that's important is because our strategies are hinged on big bank levels and institutional volume profile strategies. So all of the strategies that we teach in our classrooms are going to be completely transferable because we track what they're doing based off of the information that we have with our indicators. And so since you've decided to learn about Forex, the chances are that you've probably looked at the stock courses, maybe options or futures. That's a good thing because you're going to have a good understanding of some of the terminology that we talk about. But if you're new to Forex or if you're new to trading and this is your first time, then this is going to be a great expansion for you. Okay, it's going to be a great expansion. So let's talk about Forex compared to stocks. Okay, when you trade the stock market, right, it's considered you're buying or selling shares of a company. It's hinged on the company itself, the product, the service, the industry, the sector, the economic cycles, etc. In the Forex market, it's not the case. You're dealing strictly with world foreign exchange products. So rather than worrying about stocks or companies or even futures contracts or anything of the nature, what we're doing is we're looking at the relationship between one currency pair compared to the other currency pair. And, you know, a good example, if you're in the USA and you're going on a trip to Europe, or if you're leaving Europe to go to the USA, when we travel, if we go into the actual airport, you're going to see a current exchange desk there. You know, that's how you exchange your currencies, right? I mean, it's simple. It's right there. You walk up, you say, listen, I want to transfer this European currency into the US dollars. I want to transfer US dollars into the euros. Right? We're buying and selling currencies. We don't even know what's going on, but technically that's the foreign exchange market. You know, that's happening globally everywhere around the world. And this is what makes trading so available to us because the only difference here is the exchange rates. The difference between the exchange rates is where we have to be mindful of, you know, the valuations of one currency paired to the next. So let's kind of talk a little bit about the distribution of currencies. Okay. Traders are actually attracted to Forex because it's extremely high levels of liquidity. Liquidity is very important because it allows us to get into the market with positions, and we can do this 24 hours around the clock, 5.5 days a week. It's also a large volume. You can get in and out of the market in fluctuations without people even knowing you're trading, right? I mean, you can go in and you're like a fly on the wall, so there's no worry about that, right? You could be trading large size, small size, it's not important. You're just going to get in and out of the market. Now, the most heavily traded currency is the US dollar. It makes up 85% of the foreign exchange market. At nearly 40% of the trading volume, okay, the euro is ahead of the third place, which is the yen. So, you know, the thing here is the three top dogs is the euro, the yen, and the US dollar. And, you know, the reason for this is because you have all these different markets paired against the US dollar as the primary. Now, we will talk about pairs and we will talk about all of the other different relationships between, you know, the majors and the minors and the exotics, and we'll get into that in the next video. But the main thing here is the US dollar is the big brother in the room. And then it goes to the euro and then the yen. So those three are the big players in the space, right? And how we treat those markets is really unique. So that doesn't mean the other markets aren't important, like the British pound, the Aussie. These are all really important markets, but those are the big players, right? So let's talk a little bit about what's driving them. This is very, very transferable to the futures class that we have on Futures 101. Unlike the stock market, which is hinged on earnings and sector analysis and then also the market, futures and Forex is completely driven by economic reports, fundamental economic drivers, federal open market committees, exchange rates. We've got bank monetary policy rates. Monetary policy information is very, very critical for foreign exchange because it has direct relationship to interest rate decisions and also the monetary rates on those currencies. Very, very important. Gross domestic product, GDP, you know, core PPI, jobless claims, unemployment rates. These are all massive reports that are going to dictate the ebb and flow of currencies around the world. It's going to dictate global trade. It's going to dictate global supply and demand in one industry to the next, which is going to be completely dependent on the valuations of a country's economic stability in the dollar. So we don't really care too much about what the reports tell us. We're more concerned about the time of day that it's coming out and what markets are being affected by that, because you if we're trading certain currency pairs, we want to make sure we're aware of the news coming out on those countries. It's going to be dictating the direction of the currency valuation. Now, two websites that are kind of our favorite is the Forex Factory and also FX Street. These are two very well-known websites that you can go to. So just go to forexfactory.com or fxstreet.com and just check out their economic calendars. You're going to be able to go to those calendars and you're going to be able to just easily see the news reports on a daily basis. We do that every day in the classrooms. You'll see that, but it's good to know those sites. You need to bookmark those on your browser. So let's talk about the market hours. So the benefit to the Forex is that it's very flexible. Unlike equities and options that are only open, the U.S. market's only open a certain time of day. Forex is open 5.5 days a week, 24 hours a day, right, with the exception of Saturday. And, the big thing here is this provides a myriad of opportunities. You can trade different market sessions, U.S. session, the Euro session, the Aussie session, the Asian session. And the big thing is you're going to have fast sessions, you're going to have slow sessions depending on your country of origin. Obviously, daylight savings times can alter this, and there's going to be session overlaps. For sure, there's going to be session overlaps like the London and the New York session, and then the New York and the overnight session. But the main thing here is that these are the main starting points for the foreign exchange markets for each of the sessions. And so, you definitely want to be aware of where you're trading. Like if you're trading the New York session, the London session, most of the volume in Forex is in the New York and the London session. So ultimately, these are the biggest volume players in the room. However, that doesn't mean you shouldn't be looking at the overnight sessions in the Sydney or the Tokyo markets. Like the Asian and the Australian markets are definitely offer good advantages if you're trading, say, the Aussie dollar, or if you're trading the Japanese yen and so forth. So just be aware of that so that you understand the times that are related to these markets, and it's good to get a baseline around that. So now this is a really big change. So I want to take some time here and I want to talk a little bit about understanding the brokers side of this business. So ultimately, everything comes from a top-down perspective. You're going to have clearing firms. You're going to have prime brokers, then you're going to have deal desk market makers, you're going to have straight through, and then you're going to have ECNs. And those are all going to bridge into introducing brokers. Now, if you're brand new to this industry, that's probably going to be completely over your head. And you're going to say, what the heck does that mean, right? Well, the truth of the matter is it's really quite simple. They all have a place in this industry, and we're going to talk about them here on the next slide. Okay, so just reference this picture here. Take a screenshot of this. As I go to the next slide, we're going to talk about the breakdown. So a clearing firm is where all the orders get settled. All brokers are associated with a clearing firm that will handle those transactions, okay? Prime brokers, so as we go down, so the clearing firm is at the top, the next step down is the prime broker. The prime broker will meet the minimum standard to stand on their own as an independent brokerage. A good example would be FXCM, and the reason for this is FXCM is a prime broker. The way they get their status is they have a lot of reserve capital on hand. They're considered a top tier broker because they have a lot of capital on hand in large amounts. So they're a big player in the space, right? And the next step down is deal desk and market makers. So if you look down here, you've got the deal desk market makers on the left and the straight through and the ECNs. We'll talk about the deal desk market makers first. So the deal desk market makers, these are retail brokers. So they take the opposing side of our trades and they actually make a market. Their price closely resembles the interbank market, but with a slight difference due to lag time. Now, I'll explain this a little bit. Their computer system watches the interbank market. They aren't tied to any exchange, and they execute trades internally by taking the opposite side of our trades. So they have to make a market for us. They do this because it's easier for them to do this to be connected to the interbank market. They know 90% of the people who open up accounts will leave in less than 90 days. Essentially, they play the house and provide the liquidity. So it's like they play the casino, so to speak, because they know that most traders struggle and they will fail. I'm not trying to discourage you, but that's the reality of the business, is that you're going to have to learn how to do this properly to succeed, which is why we're here. And the reason why these market makers exist is because they take the opposing side of the market, right? So they're making a market. Let's talk about the straight-through brokers. Straight-through processing brokers, these are brokers who send the orders that have been placed by their clients on their platforms directly to liquidity providers like banks or larger brokers without passing these orders through a dealing desk. Okay, so straight-through brokers are connected to the interbank exchange and have the option to route your orders to the interbank. Okay, Now, it's important to understand that we have no way to know if their broker is taking the other side of our trade or not. This is pretty much as sure as they're making a market for our orders, right? And if a trader is not the experience and it actually takes losses, the STB, or straight through broker, will take the opposing side of your trade and provide a market. If they see that you're making profits and they realize that they can't actually make money from you, they will route your order directly through to the IB. So you got to kind of understand what's taking place here. Is like they know whether you're a good trader or not, and that'll dictate how they trade against you, or if they process you through to right through to an IB. And regardless, all that matters is they handle your order accurately. Now, the next one here is ECNs. ECN brokers, electronic communication network. Okay. This is basically order routing directly to the introducing brokers. They have no vested interest in the trades you take and simply make a commission on every trade you take. They are simply a conduit between you and the IB. So an introducing broker routes the orders to several different brokers, and these are normally home-based shops, meaning you can contact them if you need to speak to them. Now, let me kind of explain this. That's kind of like the Cliff Notes version. At the end of the day, we're in such a technologically advanced environment now with retail trading and all of our platforms. All that really matters, so that you don't overcomplicate that entire overload of information, is that you need a reputable platform, which we deal with. You need a reputable broker, which we can refer you to, and you just facilitate trade on the platforms. You don't need to worry about all that stuff. All you need to worry about is learning how to trade and placing your orders accurately, because all this stuff that happens behind the scenes is all done electronically anyways, and all that you need to worry about is getting good trading. Okay, so this is just to give you theory on the big broker side of it, because it's a lot different than futures and stocks. It's a completely different industry, and I'll explain what that looks like. This is why the Forex market is completely different than, say, the futures markets or the stock markets, right? Because it's a decentralized, a normal versus a centralized exchange. So I'll explain something here. Each independent trader, including you, will have a broker. Each broker is tied into the exchange. In Forex, this is a bit different. We have an interbank exchange. So essentially, we go to broker A, the next trader goes to broker B, trader 2 goes to broker C, trader 3 goes to broker D, and they're all plugging into the interbank exchange, right? They're all going into this interbank exchange, which is a huge normal market exchange. Now, the difference here, okay, this is a normal market exchange. This is basically a normalized market. Now, with Forex, okay, in a centralized market exchange, what happens is inside that environment, they can communicate and they can basically choose how this works, right? You can go and your broker goes into one. Now broker B plugs into a different bank inside that centralized exchange. Then trader 2 and trader 3, they deal with broker C and broker D, but they're both communicating into that. So all these brokers all have a bigger pool of communication between each other, and they have the ability to choose where they're going to get their routing from. And that's the big difference between the futures, the Forex, and the stock market. The Forex market has that centralized market exchange. Now, I'll give you an example. This is just me explaining this in a little bit more detail. On the prior slide, you can see the examples of how inside the interbank is a series of large banks, okay? And they are all connected via the interbank market. Each of these banks will set their own exchange rate and currency prices. This is what creates price differences between each currency and each bank. This is the differences between brokers. So broker A is connected to the interbank. So a good example of broker A is connected to the interbank. And then broker B is connected to one of the banks inside the interbank, where brokers C and D are also connected to the interbank exchange, but they make their own market. So one of the downsides to FX is the differences in price quotes from broker to broker, which is one of the reasons why we spend so much time working with very liquid brokers, very reputable platforms and brokers, so that you're not dealing with these fly-by-night brokers that everybody fears in the Forex market. And we're no longer in that environment. Like, the Forex market is such a large environment now that, you know, sometimes you've always heard these nightmare stories. Well, oh, I can't, you know, I don't trust my broker. Forex is deregulated. You only need to worry about that if you're in a country that's very, very, you know, basically behind the bar, so to speak, in terms of evolution. And also if you're in a country where it's really hard to open up,
bank accounts and these types of things, where if you're in major first world countries, or even if you're in second world countries and you still have good banking systems, you can connect to really reputable brokers, and you have no issue with this. So this is a breakdown of theory. It's completely different than futures and stocks, but it's really important to know the difference, because the way that the interbank works with banks inside of it, and it has a lot to do with why the currency rates change and the exchange rates change. And it also has a lot to do with spreads in between the markets. So this is one of the things you're going to learn about the Forex markets. There's always the spread is a little bit bigger than, say, other markets. And so if you have questions on this, I don't blame you. Most people will. Shoot us an email. We can break it down in more detail if you don't understand. But my main suggestion moving forward is to not get caught up in the semantics and the basics of this. All that matters is that you follow direction, learn how to trade, learn the platform, get a good broker. We'll refer you to a few of our preferred brokers that we deal with, and then ultimately you can just make sure that you're dealing with a very liquid, very high level broker with a top tier environment, and then you'll never have to worry about anything. And more importantly, you don't even need to worry about all that stuff happening behind the scenes, because it happens automatically. As soon as you hit the buy or sell button, those orders go through to all of that takes place instantaneously. You're not even thinking about it, right? And you just need to worry about getting good as a trader. So we're going to help you do that moving forward. Take care, traders, and we'll see you in the next video.
Hey there, welcome back here. Super excited about this video. I'm glad you love the content. Make sure you check those videos out below, because we've got other videos in the series that are going to pick up where we leave off, and we're going to make sure that we can empower you moving forward as a professional trader. Be sure to hit that subscribe button. That's going to help our channel grow. And make sure you share this video with a friend, because I know they'll benefit just like you. Make sure you ask a question and leave a comment below so we can get social with you, and we'll see you in the next video.